Welcome. Today, we're taking a closer look at one of Spain's most influential companies, a true powerhouse in the world of energy, Repsol. Headquartered in Madrid, Repsol is not just a major force in global energy, but also a cornerstone of Spain's economy and a symbol of the country's industrial strength. With operations spanning more than 30 countries, Repsol's reach extends far beyond Spanish borders, making it a key player on the international stage. Repsol is what's known as an integrated energy company. That means it's involved in every step of the process, from searching for oil and gas deep underground to refining those raw materials, and finally selling the finished products at its own branded gas stations across Europe and beyond. The company's business is divided into two main segments, upstream and downstream. This structure allows Repsol to manage risk and capture value at multiple points in the energy supply chain. The upstream segment is all about exploration and production, finding new reserves of oil and gas, drilling wells, and extracting these valuable resources from both land and sea. This is where the adventure and risk of the energy business really come into play. Upstream operations tend to thrive when global oil prices are high, generating strong profits. But when prices drop, this side of the business can face significant challenges, as costs remain high while revenues fall. On the other hand, the downstream segment covers refining and marketing. Here, Repsol takes crude oil and transforms it into everyday products like gasoline, diesel, and jet fuel, which are then distributed and sold to consumers and businesses. Repsol operates several large, state-of-the-art refineries, mainly located in Spain. These facilities are crucial for turning raw materials into high-quality fuels and chemicals, capturing value at every stage of the process. But Repsol isn't just about oil and gas. The company is investing heavily in renewable energy, like wind and solar power, as the world shifts toward cleaner, more sustainable sources of energy. This is a key part of Repsol's long-term strategy. By balancing its traditional oil and gas operations with a growing portfolio of green energy projects, Repsol is positioning itself as a bellwether for the future of the energy sector, one that's adapting to new realities while leveraging its deep expertise. Think of Repsol as a company with deep roots in the oil and gas industry, but with an eye firmly on the future. Its growing stake in the energy transition shows its commitment to evolving alongside global trends and environmental demands. The company's performance reflects both the challenges and opportunities facing the global energy industry today. From volatile oil prices to the push for decarbonization, Repsol's journey mirrors the sector's biggest shifts. As we'll see in the next chapter, this delicate balance between tradition and innovation is crucial to understanding why Repsol's stock has recently made headlines. Let's dive in and discover what sets this Spanish energy giant apart. On January 15, 2026, Repsol's stock dropped over 5%, a huge move for such a large company. The trigger? A downgrade from the Royal Bank of Canada, or RBC. RBC's analysts are highly influential, and their negative outlook sent shockwaves through the market. Automated trading systems and fund managers reacted instantly, accelerating the sell-off. The downgrade wasn't about a scandal or operational disaster. Instead, RBC cited a less favorable economic environment and concerns about Repsol's profitability, especially in refining. This shift in sentiment led investors to question whether holding Repsol shares was still a smart bet. The result? Billions wiped from Repsol's market value in hours. So, what does a downgrade mean, and why does it matter so much in the world of investing? Let's break it down in simple terms. Think of analysts as critics. They're the experts who study companies and rate their stocks as buy, hold, or sell. These ratings help investors decide where to put their money, much like movie critics guide you on what to watch. A downgrade happens when an analyst lowers their rating for a stock. This shift signals that the analyst now has less confidence in the company's future performance, often due to new risks, disappointing results, or changes in the industry. In Repsol's case, RBC Capital Markets moved its rating from sector perform to underperform. That's a clear warning sign, suggesting that Repsol may not keep up with other companies in its sector and could even fall behind. These ratings aren't direct orders to buy or sell, but they carry weight because they're based on deep research, financial modeling, and a close look at the company's prospects. Investors and fund managers pay close attention to these signals. Along with ratings, analysts also set price targets, estimates of where they think the stock price will go. When a downgrade happens, the price target usually drops as well, reflecting a more cautious outlook. For Repsol, this meant not only a negative rating, but also a reduced price forecast, making it clear that expectations for the company had shifted downward. When a major bank downgrades a stock, it's like a trusted guide warning you that the path ahead is getting rough. It doesn't guarantee trouble, but it's a signal to be cautious and reconsider your route. Investors often react quickly to these warnings. Many will sell their shares, sometimes in large numbers, which can drive the stock price down sharply in a matter of hours. Downgrades can reshape market sentiment in a single day, turning optimism into caution or even fear, and causing ripple effects across the market. For Repsol, this downgrade was a wake-up call for both management and shareholders, forcing them to reassess their strategies and expectations. The market took notice and acted, showing just how powerful a single analyst's opinion can be in shaping the fate of a company's stock. To understand RBC's concern, let's talk refining margins. Refining margin is the difference between what a company earns from selling refined products and what it pays for crude oil. Think of it like a baker's profit cake price minus ingredient cost. For Repsol, strong refining margins mean big profits. Weak margins mean earnings shrink. These margins fluctuate with supply, demand, and economic cycles. When demand for fuel rises, margins widen. When supply outpaces demand, margins shrink. Analysts watch these margins closely. They're a key indicator of future earnings. RBC's report flagged weakening refining margins as a major risk. For Repsol, that spells trouble for its core business. RBC saw that Repsol's refining margins, once unusually high, are now falling back to normal levels. This normalization means profits from refining are slowing down. Repsol's stock price has historically tracked these margins closely. As margins shrink, so does the stock's potential for gains. The reasons? Slower global economic growth and increased refinery output worldwide. More supply and weaker demand push down fuel prices, squeezing profits. RBC's downgrade was a warning. The market hadn't fully priced in this shift. Investors needed to adjust their expectations fast. Repsol is facing a tough financial environment as shrinking refining margins take a heavy toll on both its earnings and cash flow. The company, which relies on processing crude oil into fuels and chemicals, is seeing its profits squeezed from multiple directions. Global market volatility, fluctuating oil prices, and increased competition have all contributed to a challenging landscape for the energy giant. When margins fall on millions of barrels processed, the impact is massive. Hundreds of millions in lost profit each quarter. This isn't just a minor setback, it's a significant blow that ripples through every part of the business, from daily operations to long-term planning. In response, RBC has slashed its earnings forecasts for Repsol, pointing to weaker refining margins and softer oil and gas prices as the main culprits. Analysts are warning that unless market conditions improve, the company's financial performance could remain under pressure for some time. Both upstream operations, like oil exploration and production, and downstream businesses, such as refining and marketing, are feeling the strain. This double blow makes it even harder for Repsol to offset losses in one area with gains in another. With less profit coming in, Repsol has less cash available to reinvest in its business, pay down existing debt, or reward shareholders with dividends and buybacks. Every euro counts, and the company must make tough choices about where to allocate its limited resources. Tight cash flow also limits Repsol's ability to expand into renewables, a key part of its future strategy, or to maintain its current level of dividend payments. The company's ambitions for growth and sustainability are now being tested by these financial constraints. Investors, especially those who count on steady dividends from energy giants, are watching closely. Falling cash flow puts those payouts at risk, raising concerns about the reliability of Repsol as a long-term investment. As a result, the company may be forced to slow the pace of dividend growth or even reduce share buybacks, which are often used to boost shareholder value. These measures, while necessary, can disappoint investors who expect consistent returns. All of this makes Repsol's stock less appealing, particularly for income-focused investors who prioritize stable dividends. The uncertainty around future payouts adds another layer of risk to holding the stock. The financial squeeze is real, and the market is taking notice. As Repsol navigates these headwinds, investors and analysts alike are watching to see how the company adapts to protect its future. Investors always compare companies to their peers. Repsol's main rivals are Shell, BP, and TotalEnergies. RBC focused on free cash flow yield, a key measure of financial health. Repsol's projected yield is 5.8%, but its peers average 6.4%. That gap matters. Investors want the best return for their money. Lower cash flow yield makes Repsol less attractive compared to competitors. As economic tailwinds fade, investors favor companies with stronger, more reliable cash flow. RBC's downgrade highlighted this weakness. The result? Investors may rotate out of Repsol and into its stronger peers. In a tough market, every percentage point counts. Repsol faces a double hit: shrinking refining margins and weaker oil and gas prices. Downstream profits are falling as margins return to normal. Upstream earnings are squeezed by lower commodity prices. In the past, one side could offset the other, but not now. Both divisions are under pressure, making future profits harder to predict. This uncertainty rattles investors, who crave stability. When visibility on earnings fades, many sell first and ask questions later. That's exactly what happened after RBC's downgrade. The market hates surprises, and Repsol delivered one. Now confidence must be rebuilt. So, what's next for Repsol and its investors? The easy profits from high margins and prices are gone. Management must now focus on cost control and efficiency to protect cash flow. Investors face a choice: hold on and hope for a rebound, or switch to stronger peers. The stock's fate will depend on refining margins and oil prices in the coming months. Long-term investors may see opportunity in the price drop, betting on Repsol's energy transition strategy. But the near-term outlook is challenging. The RBC downgrade is a reminder of how quickly sentiment can shift in the energy sector. All eyes are now on Repsol's next earnings report for answers. The market has been warned. Now it waits for Repsol's response.